Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. Good day, James. So
back in the normal cafe.
That's right.
Well, you and Stephen were back in the normal cafe last week.
That's right. But you, the last time I saw you was in Blondie over there from the ABC talking to Jim Chalmers.
Big Jim.
What
a moment.
So last night, US GDP, the US is in recession.
No, it's not in recession. But the US economy is shrinking. Sort of, there's a bit of important context here. The economy, US GDP went down by 0.3%. The issue that the US have got is that a lot of people tried to front-run the tariffs. And so there's a big boom in imports, and imports detract from US GDP.
We should probably explain why imports are subtracted by statisticians from GDP is because they appear in retail sales.
Yes,
they're actually added to GDP at the other end.
Yes.
And
the money appears on someone else's GDP.
Correct.
So it's foreign owned, seen as
double counting, and then the things aren't produced here.
Yeah.
But you have to subtract them from GDP because they're added at the other end.
Yeah. And
you need it to be zero.
Yeah. So look, I mean, to my mind, I think there's two interesting things. One is that it's a preview of what's coming. You know, there's a reason everybody front-run these tariffs, and that's because trade between US and China is stopping and has stopped in lots of places.
I've heard about the ports on the West Coast.
Blank sailings.
They're kind of, the ports are empty. Los Angeles and Seattle apparently have no ships in them.
Yeah, I mean, it's extraordinary that we're talking about that. But I think the other thing is the market has rallied for 7 straight sessions in America. It's up 12% since it touched the bottom on April 8. It's extraordinary. The price to earnings ratio of the market is now back above 20 times. And
so how are the smarties explaining that?
Oh, well, actually one of the big reasons is the smart money keeps saying, well, it's the dumb money. And I use that term in quotation marks. I don't think, but it's retail investors that have led a lot of the buying. And they're buying because bond yields have ticked down a bit, which is good news, but they're believing that there's going to be trade deals. And they're believing that they're going to come soon and that we'll all wake up from this whole trade nightmare. And
so it's Trump's base who is buying?
Well, I'm not sure.
I'm not sure. No, but I'm not sure the Democrat voters think there's going to be trade deals. They all think it's going to hell.
Look, I mean, is it just that retail investors have been conditioned to buy the dip for 3 years and it's worked and they're doing it again? I don't know, but I just,
Well, you know what? I'm not buying the dip.
Well, I mean...
I'm not.
I just... This week has been so instructive to me on the US-China trade deal, which is the only trade deal that matters. Now, everything else is, sort of sideline stuff. We're not even remotely close to getting one of those. I mean, Scott Besson is out there saying, there's talks between China and America at all levels. And then he was asked, well, what does that mean? And he said, well, I saw the Chinese guys down at the IMF meetings last week and we had a chat. Like, that's not trade talk. And even if there's a trade deal, this is the bit that I don't quite get. Even if there's a trade deal, does anyone in the world expect either US and China tensions will subside to the point where they won't be picking at each other for the next century, or Donald Trump will stick to the thing? I mean...
But also, the other thing is the trade deals take a long time to work out.
Real ones
do. That's right. You don't do a trade deal in a month.
No. Let alone 90 in 90 days.
I remember when our free trade deal with China or even America was being negotiated, it took years to do.
So I think anyone buying into Wall Street at the moment needs to be really careful. And look, the Australian market's bounced back hard too. I guess what I'm saying is stocks are not...
Commonwealth Bank's going up again.
Oh, I know.
Jeez.
US stocks are not priced for a recession. They are still expecting earnings growth of 9% in 2025 and 14% in 2026. Now, how that happens if there's a US recession is beyond me. So,
and the US market's PE is 32 times, right? It's down a bit.
It is.
But only down a bit. It's still 32 times. And the rest of the world's PE is an average of 15.
Yeah,
Right. So
yeah.
it's still more than double the valuation of the rest of the world.
Yeah, I think it's time to be really careful. And this rally says to me that people want this to be over, and I get that. I'm getting up at staying up late and getting up every morning to write about the trade wars. I'd rather it was over too, but it's not over, not remotely.
No, I agree.
Anyway, that's my rant. I'm getting increasingly accused of being increasingly bearish. So, but there it is.
But you are saying that the US economy is not in recession.
It's not in recession. No. And look, I don't. America is not so. You know more about this than me, but I don't think America really likes the 2 quarters of negative growth definition.
They don't go with it.
Yeah, they have a few other definitions.
No,
right?
what they have is the National Bureau of Economic Research, which is a kind of a government body. And the NBER actually declares it.
Yeah.
And they
after
say
the fact.
After the fact, and they say the recession began on, January the 2nd, and it's possible. It is possible the NBER will come out later this year and say, well, the recession began in March.
Yeah.
Who knows?
I think it's a.
I mean, the other definition of recession that's catching on in the US is the Sahm rule.
Yeah.
Named after Claudia Sahm, S-A-H-M.
Yeah.
And she decreed that a recession happens when unemployment rises more than 50 basis points
Yep.
from the cycle low, as long as the cycle low is within 12 months.
Yeah.
So it's got to have increased 0.5% within 12 months, and that,
Yeah, well, we're getting US job figures on Friday morning. They'll be hugely interesting, and the next 5 sets of US job figures are going to be unbelievably closely watched.
Yes, that's right. And we had Australian inflation yesterday. And
Doing the right thing?
Definitely. Yeah.
I mean, are you in the 50 basis point rate cut or the 25 basis point rate cut in May? Seems like we're getting something.
Listen, I'm a little bit inclined to think they might go for 35 basis points.
Oh, even up. The even up rule.
Well, they're at 4.1 now.
Yeah.
In order to, it must feel a bit weird for them to be at 4.1 rather than 4.25 and 4 and 4.75.
Yeah.
So I reckon there's a chance they'll go back to 4.75 and make it 35 basis points. But I think on balance, probably 25 basis points, 0.25%. But I think that it's worth noting that although it's true that the trim mean inflation rate was 2.9% for the year, I don't reckon the annual figure is relevant, really. What matters more is 6 months annualised.
Yep.
Because it's more recent.
Yep.
The annual one is it relies on, depends on what happened 12 months ago.
Yeah.
And so over the 6 months, as I noted on the ABC News last night.
Yes.
As I'm sure you saw.
Always watching.
Annualised 6 month trim mean was 2.45%. So under the midpoint of the RBA target range. So look, I reckon they can declare job done.
Oh, job done. Standing on the aircraft carrier.
I reckon.
Mission accomplished.
Mission accomplished.
I reckon there's no chance they'll do that. I mean, I think you're probably right. They're getting towards job done. But is there a lot of reason to... So does the economy need a lot of support or just a little bit of sort of support and a touch of insurance, perhaps, from what's coming?
Well, the trouble is they don't know. I mean, nobody knows really what's coming. That's the problem.
Yeah.
We don't really know what's going to happen to the Chinese economy, really.
Yeah.
I mean, that'll depend on what the Chinese government does in terms of fiscal support, and they kind of they're a bit constrained by the fact that they've got all this debt.
Yeah.
I mean, but I don't know whether they care or not, about the debt. Maybe they don't.
Look, yeah, it is interesting. You sort of see there was a good line in a note the other day that the situations in China and the US are remarkably different. One is about to stimulate, the other is cutting government spending. One is deeply divided, and the other, for whatever reason, has one party and one way of seeing the world.
They're undivided.
They are undivided. So, yeah, they don't seem to be for turning, which comes back to that trade deal thing. Like, the Chinese want as much leverage here as possible. They have no reason to roll over yet.
No.
They want to. They will have their. They want the people at in the Chinese consulates and embassies to go out to the Target store in Middle America, see the empty shelves, and then they'll report back and say, "Yep, now we can start making a deal because we've got a bit of leverage."
I meant to explain before we moved on. I meant to explain what the trim mean is. Just
sorry. Yep.
No, just so because everyone talks about the trim mean. I'm not sure anyone really knows what it is.
Other than losers like us.
Well, that's right. What they do to get the trim mean is they lop off the biggest 15% and the smallest 15% of price changes. They basically lay out all the price changes in a row, and the top and bottom 15% get chopped off, and they end up with 70% in the middle, and they say that 70% is the core inflation rate because they reckon that the big ones, small and little, or prices that have fallen and risen a lot, are volatile items, and they change. Volatile items tend to change a lot, so what they want is the core.
It's a bit like the judging in the diving in the Olympics. You take out the Russian judge and the the Japanese judges' scores from the top of the bottom, and you look at the middle ones.
I didn't know that.
There you go.
Is that right?
Yeah, trimmed mean judging.
Trimmed mean in the diving.
Yeah, that's right.
Gracious.
Suddenly right into it.
So who's going to win the election, James?
I ran into at the AFL football last week, Collingwood versus Essendon. I know you're a big Bomber, so I'm sorry to tell you about this, but I ran into a Labor person at the footy. They were working very hard to keep things under wraps, but they can see the path to a small Labor majority government.
Which is what they have now.
Yeah, which is what they have now. And so I think my sense is that holds. Dutton's momentum has been smacked since Trump's Liberation Day, bit like we saw in Canada. It's just opened the door for the anti-Trump candidate to do a lot better, to gain all the momentum.
So I reckon if the Labor Party holds its majority, it'll be a total triumph. I mean, it'll be incredible.
Why?
Because
every first government,
the two-decade trend. No, I'm not saying they won't. I'm not saying they won't. Anthony Albanese won't be prime minister next week. I think he will be.
Yeah.
But the trend has been for decades for both parties, both major parties, votes to decline. And if they manage to not decline their vote,
that would be a triumph. Yeah.
I mean, that's what I'm saying. Okay, maybe we're talking of two different things. There's number of seats and percentage vote, I guess. Number of seats, they've got 77 now out of 150. They could hang on to 100. They could hang on to 77 while their vote also declines. That's true.
Yep.
Depending on how the preferences work, but look. If
you're saying if they can hold the line, basically,
if they can hold the line, it'll be fantastic. Yeah. I mean, really, and I think they can thank Peter Dutton for it because he's actually made such a hash of the campaign.
Yeah,
it's unbelievable. Yeah. What a mess Dutton has been.
Yeah, I just harking back to our episode with Jim Chalmers, I was really surprised when he said the thing he didn't expect was the work from home backlash. Like, it's such a simple sort of, you would think, peripheral issue. And it's clearly symptomatic of the way the coalition just haven't got this right. They've just they've tried to sort of be a bit macho and aggressive and just read things terribly.
Yeah, but what about, Peter Dutton tried for a while to be Mr. Nice Guy, and he got his family on TV, and he was kind of softening up the image and all that stuff. He's chucked all that out the window in the last week, and he's gone hard again.
Yeah.
And he's calling he's calling the ABC and the Guardian hate media.
Well, you are, aren't you?
No, I mean, honestly, Jesus. I think it's just crazy all over the place. But also, that working from home was not his only mistake. There was tons of mistakes.
But I mean, I guess what is remarkable to me about this year generally, and you would say it about politics and markets, how much has changed in 12 weeks. In 12 weeks, we've gone from Peter Dutton, looking very strong, maybe pulling off the miracle given how far behind he was, and US exceptionalism being the narrative on markets.
Yeah.
The Magnificent Seven tech stocks looking unassailable. In 12 weeks, it's just all
Yeah.
fallen apart.
Well, Trump hasn't helped Dutton.
No,
either.
no, not at all.
Because
Not
Dutton, to some extent, deliberately has identified himself with Trump.
Yeah.
And
Certainly initially when Trump enjoyed that sort of swell of support.
certainly initially.
At the start.
That's right.
Can I just ask you, Alan, we've got a lot of questions. I know we'll get to questions in a second, but just to get ahead of that, we had a lot of questions about Mark Carney along the lines of, the new Canadian Prime Minister. And a lot of the questions were along the lines of, why can't we have our own Mark Carney? So Mark Carney, for those who don't know, used to be the Goldman Sachs banker, then ran the Bank of Canada, then ran the Bank of England, and is now the new Canadian Prime Minister on the left, from the left. What have you made of his? What do you make of his victory? Does it speak to that same sort of anti-Trump sentiment?
Oh, totally, of course.
Yeah.
I mean, 3 months ago, talking about what's happened in 3 months, I think 3 months ago, the Conservatives in Canada were well ahead.
They were home.
They were home. They're going to win. And now the Conservative leader, I can't pronounce his name, but
Pierre
Poilievre has lost his seat.
Yeah, has he?
He lost his seat.
Oh, I knew he was on the brink of that.
He's done a John Howard.
Oh no, that's no good. It's interesting. I mean, Carney, and again, 12 weeks ago, Carney would have been in the, gleefully labelled by the sort of Trump side of the world as a globalist, leftist, wokist, climate change type of dude, and now he's managed to turn things around for the left in Canada. So look,
So what we need then is Philip Lowe or Glenn Stevens to stand as,
I confess I have a few times this week tried to picture Phil Lowe as the Prime Minister.
Or even less likely, Glenn Stevens.
Wow.
Imagine.
I mean, Philip Lowe is just such a careful guy. Can you imagine him sort of standing up in Parliament? He would sort of go with it, well, this is possible and so is this possible on one hand and the other hand.
I know. And Glenn Stevens is so grumpy. I mean, so, yeah. No.
Maybe Michelle Bullock is in a couple of years is the ideal person.
Yeah, no, but I think looking at Mark Carney now and watching his interviews and everything, you can think, oh, actually, he was probably a politician all along.
Maybe.
He's kind of, he was a politician inside of him waiting to get out.
And there's a bit of that in being a central bank governor. We're going off the track here, I know. But Stevens and Lowe, we didn't see them now that Michelle Bullock has to have this post-meeting press conference, it's changed her job, I reckon. She has to go out there and do a bit more of the politician and sell the decision.
Too, yeah, that's right, exactly.
So maybe it's Michelle Bullock for PM.
Well, the other thing is Mark Carney's a PhD in economics. Mm-hmm. So is Jim Chalmers.
Oh, okay. Gotcha. Right.
No, really.
Dr. Jim, of course.
Dr. Jim, he did his PhD, his thesis was on Paul Keating.
Yes.
So, but still, that was a valid and constructive subject for a thesis, I reckon.
Yeah, well. Anyway, enjoy your sausage sizzle on Saturday. Vote early, vote often.
Well, I'm waiting to vote on Saturday.
Yeah, me too.
Because I want to be part of I want to be part of the Democratic Festival.
Exactly, and you see the pre-polls around Australia. The lines look bigger than they'll be on Saturday.
It's incredible.
What's going on?
And I was driving past one of the polling places the other day, and there's just festooned with call flutes.
Oh yeah.
Anyway, okay. Before we get to the questions, here's a quick word from our sponsor.
Want to take control of your financial future and sharpen your investing skills? InvestSMART's Bootcamp for Beginners is the perfect place to start. This flexible online course covers everything from the basics of investing to creating lasting wealth and building better money habits. Access on-demand videos for 3 months and learn at your own pace whenever it's convenient for you. Usually $99, Money Café listeners can save $50 with the code MONEY50. Head to investsmart.com.au/bootcamp and use MONEY50 to save big today.
Pat says, I love your podcast. I love your value your experience and expertise. My question, I'm building what I want to be a properly diversified portfolio of ETFs. My studies show that in the international space, the top 10 holdings are largely the same in all of those I'm looking at, but with percentages varying from 25% or so up to 100%. So without providing financial advice, can you give guidance on how many of the VGS, Qual, 100, IVV, NTQ and FANG should be selected, and which of them can be successfully combined with a diversified portfolio?
This is a really interesting question because I hadn't thought of this. I mean, most people, will often get told, or the sort of general advice is, I'll go and buy, maybe a US equity ETF, maybe a tech ETF. But Pat's right. You're getting a lot of the same stuff in those ETFs, and so
that's right.
To be careful. I mean, I don't think there's any hard and fast rules about diversification in ETFs, though, right?
No, but I do think that there's not much point trying to diversify by buying lots of ETFs, right? Because the ETFs themselves represent diversification.
True.
If you want to diversify in the Australian market,
yes,
all you need to do is buy the ASX 200 ETF.
Yes.
And you're getting the ASX 200.
So Pat's overthinking it a bit.
Possibly, but you can diversify by perhaps basing your portfolio around a single market ETF, whatever it might be, and then say, okay, I'm going to add to that some specific ETFs, like a Japan ETF.
Yep, or a robotics ETF.
Or a robotics ETF, or a US ETF. And so you think about geographic diversification and then topic diversification or industry type for diversification.
Yep.
And then try to ensure that you're doing it in such a way that you're not particularly doubling up. For example, if you've got an ASX 200 ETF, you've got a fair bit of CSL in there.
Yeah.
So you might not want to also get a healthcare ETF.
Australian healthcare ETF.
Australian healthcare ETF because, obviously that's going to be dominated by CSL as well.
Yep.
So you're already in CSL. And likewise, if you've got an ASX 200 ETF, you've got a lot of banks.
Yep. Good
so
point.
no point getting a banking ETF.
Yep.
But there is a point getting a American banking ETF.
Yes, because they play a smaller role in the overall market.
Well, no, they've got no role in the ASX 200.
No, sure, but if you've got a S&P 500 ETF,
that's
do
right.
you need to double up with a American banking
well,
ETF?
more so than Australia, because Australian banks are 30% of the market, but they're not in the US. I think they're like 10% or less.
Pat, I reckon your research is leading you in the right direction, so that's good idea. Charlotte says, when I was a teenager, I'd never thought I would be rushed to the living room to catch the finance report on the ABC Nightly News, or submit a question to the Money Podcast. Here we all are, Charlotte. Thanks for your question. I'm wondering what your thoughts on whether there'll ever be any changes to rental laws in Australia. Do you think there's any chance Australia may change the laws to reflect places like Germany, where leases are longer and give more stability, particularly to young families? I know being able to secure a 5-year lease would ease some anxiety.
Yes, well, I think there has to be changes to the laws. First thing that needs to happen is they're nationalised. They're made they're made uniform across Australia. At the moment, every state has a different set of rental laws, which are all over the place. It's absolutely hopeless. So that's the first thing that needs to happen. And then secondly, there needs to be a meeting where they all get together and they go, okay, what do we want? How do we want to manage rental? Because the current situation is terrible. One of the problems is that there's too much stock going into Airbnb, but that's perhaps another issue.
Yep.
Not enough long-term leases, and also the power balance between tenants and landlords is far too weighted towards landlords.
The build-to-rent sector is designed to have longer leases, isn't it?
Well, they have to because, that's right. The institutions in that situation, the institutions own the block of flats.
Yeah, they want a 5-year tenant.
And they want 10-year tenants.
Yeah.
They've got their shops, they've got their retailers on 15 to 20-year leases in shopping centres.
Yeah.
Those superannuation funds.
I guess my point is, do we see laws or do we see the market shift? Maybe a bit of both.
Oh, well, you possibly, as long as there's more built to rent, I guess.
Yeah.
But look, that's going to be a long-term process. I just think I'm not quite sure how the law would actually decree long-term leases. To be honest, I guess.
Yeah, that's.
I'm not sure how that would happen, but I do think there needs to be some shift. I mean, I've often people poo-poo me when I say this. I reckon one of the problems is you can't have pets.
Right.
Or at least it's difficult to have a pet in a rental. which is, I think, a problem. Most Australians, 70% of Australians want to have a pet. You know, it's like, come on.
Yeah, come on. Got to be room for the guinea pig.
No, the dog.
We've got a guinea pig. We don't have a dog. We're getting off the track.
What's the guinea pig's name?
Iggy.
Iggy.
Yeah, Iggy. He's
Is that after Iggy Pop?
Oh no, my son named him. Guinea pigs don't bring a lot to the table.
Short for Ignatius, no doubt.
Oh, short for something. He's a pooing machine, is all I'll say.
Yeah, but that'd be little poos.
Yeah.
India says, just had a quick question about the First Home Super Saver Scheme and saving for a home deposit. I'm currently using this scheme and I'm quite conflicted because every podcast that I seem to listen to recommends not investing your house deposit in the share market because you don't know what it's going to be like when you go to take it out. Also tax implications when selling, but in the same breath we'll recommend using the First Home Super Saver Scheme, which is also invested in the share market. As I understand it, when I apply to the ATO for determination of my super that I can withdraw, my super fund will have to sell the shares. It's the same process. It's just that I've saved potentially a little bit of tax. You're absolutely right, India. It's very interesting. That's a very good question.
Yeah, it is the same process, but the tax benefit is the point, isn't it?
That is the point.
Yeah.
That's right. The whole thing is that what they're saying to you, you can save for a house deposit with a bit of a tax break.
Yeah.
Which, maybe that's right. She's right in the sense that the tax break is offset to some extent by the fact that the share market is volatile and super returns do tend to go up and down.
Yeah, sure. But I guess the point is that when you net off the tax and what you're earning, what you're hopefully earning above the cash rate, it gets you there a little bit faster. Probably not heaps faster, but a little bit faster.
A little bit faster,
Yeah.
That's correct.
Yeah. But India, you've identified a pretty sensible conundrum, but I think the government is trying to put its finger on the scale and tip things slightly in your favour through the Homes Super Saver Scheme.
Well, it's interesting. I think it's a bit like the downsizer benefit, whereas if you downsize, you get to put $300,000 of the amount into super, which is just for the tax benefit. But I think what it shows is that this is really the only way the federal government actually can do stuff because it's got control of the superannuation system. And really what should happen is the stamp duty system is used to provide people with a bit of a benefit.
Yep.
Particularly for downsizers, but also first home buyers. But the states can't and won't do it because they control stamp duty.
Yeah.
Anyway.
Samantha says, I'm one of your dedicated female listeners. A bit of Alan Kohler and Co. while popping on the makeup. Thank you, Samantha. Now, she says, you're the expert, Alan, on housing and getting more people into homes. She understands there's a shortage, but she's all about a quick win. An obvious one is for APRA to remove the 3% buffer on home lending. For those who don't get it, APRA makes the banks test a borrower's ability to withstand interest rates that are 3% higher than the variable rate. Samantha says if it sat at 2.5% for long enough and they made it go even lower for first home buyers, say 1.5% or 0% even, would this help? What are your thoughts?
Well, it's another way of helping first home buyers. All the focus is on helping first home buyers. They're giving them lots of breaks of various sorts. All that does is push prices up more because it allows first home buyers to pay more.
Yeah.
So that's certainly what would happen if you
more.
reduce the buffer. I mean, listen, I'm not a big fan of a 3% buffer. I think that probably it should come back down to 22.5% because it was put up to 3% in the pandemic or the GFC. Christ, I can't remember.
Before, yeah. No, not the GFC. I think pre-pandemic.
But look, so look, I think the emergency's passed. They could probably put it back to 2.5%. But really, even that's not going to help. It's not going to help housing affordability because it allows first home buyers to pay a bit more and push the price up.
I saw just on that. I'm just reaching for my Twitter. I saw an interesting thing from a property analyst whose name is Cameron Kushner this morning.
Yes.
Sorry, I'm just finding it here. And his point was that according to the ABS, the average new loan size in December 2024 was $666,000. The current average interest rate of 6.01%. Someone with a 30-year mortgage will pay $48K a year for that mortgage and $1.4 million in repayments over the life of the mortgage. Now, that's a lot of money. I wonder if that sort of proves the point of the serviceability buffer. People are taking on very large amounts of debt. They're taking on very large repayments. The serviceability buffer is designed to make sure that if rates go up, they've actually can withstand it.
Sure.
Now, as those numbers that Cameron's provided there, he's raising a good question. Can people withstand it? There's not a lot of fat for people if rates go up.
No, that's
on
right.
the average loan.
No, I don't
the
think
serviceability buffer's got a point.
I don't think the buffer should go to 0 for sure. I agree.
Yeah.
I'm just wondering whether it needs to stay at 3. But all right, anyway, I don't think it matters much. Emily, is it your turn?
Yeah, your turn.
Emily says, I heard Stephen lamenting last week about the lack of questions from
Not
women.
today.
Here we are. We've got so many women today.
Fantastic.
Do I have a question? I do have a question. Asking your views on wrap superannuation schemes. I spoke with a financial planner who thought these were a great idea, but I've never heard of them and no one I know uses them. What are your thoughts on wraps?
I'm in Emily's camp. This is not an area that I'm very familiar with.
No, look, wraps.
How's that sigh? I mean, what are they designed to do? Pull together wrap together different
investments
and financial strategies.
It's really they're used. They're one of the ways that people organise their self-managed super funds.
Yeah.
So it really, in order to make it work, Emily, you've got to have a self-managed super fund, which means you've got to have enough money to make that worthwhile. Because when you've got a self-managed super fund, you're paying dollars rather than percentages to have it looked after. You're paying your accountant an amount of money, which is maybe $1,000 a year or something.
Yep.
And to make that worthwhile, you've got to have $100,000 in the super.
Yeah.
Right.
And it's not just the money. You've also got to have the time, and the headspace to run the thing.
Yeah, but the thing about a wrap is somebody else looks after it, right? So the financial planner runs it for you. But the problem with that, Emily, is that the financial planners tend to be expensive.
Another cost.
They'll cost a fair bit. So with the wrap, you're paying for the management of the wrap, plus you're paying for the things they're investing in. Probably their managed funds within the wrap that are charging 1 or 1.5% as well. So the fees mount up. So just keep an eye if you're looking at it, Emily, or anyone else. Keep an eye on the fees.
Yeah, fair enough. Tiffany has got a great question, Alan. I know it's hard to predict where the stock market's going to be in a week, but she would like to understand the possible effects of population deceleration on the share market in the year 2100. The UN said it's possible that global population could plateau or possibly decrease by 2080. If that happens, what's the effect on the share market? We buy shares today with the semi-educated presumption that people will pay more for them in the future. However, with a stabilised or decreasing population, will there be the same or less demand for the shares as when they were purchased? This is a great question. I've got no idea quite how to answer it, but it's a really interesting idea.
Well, it is true that global population growth is declining, and some countries are going backwards.
Yeah.
Look, there are two sources of economic growth. One is population growth. The other is productivity.
Yes.
The population growth.
Great. We're going really well on both. Yep. Keep going.
Precisely. No. Well, population growth in Australia is strong.
Sure. Yeah.
Because of immigration, but natural increase is not going great, which is why we have to have so much immigration. So yeah, look, the Western world is probably going to continue to have population growth, because the only places where there is continuing population growth is Africa, mainly, and the Middle East to some extent, and they're all showing up in the Western countries.
Yeah.
So look, but also even if global population growth slows to 0, there's still possible productivity growth.
Yes, and the reason there would be is because we get technology, AI coming through in a big way and spurring that productivity growth that economic growth,
which comes from robots taking over from human beings.
Exactly,
because when you divide GDP by the number of human beings,
yes,
you're not counting the number of robots.
So, yes. We're not getting back into that robot slave argument. I think this is a fascinating question, but obviously it's hard to answer out to 2100. But I think I think Tiffany, I'd be thinking about a sort of number of competing forces. You've got AI coming in with the sort of idea of replacing humans and pushing the marginal cost of everything as low as possible. So, what's anything sort of worth in an AI world where everything's really cheap because robots are making it?
And what's the world going to be like in 2100?
Exactly, yeah.
Just have no idea. I don't think we have any idea what it's going to be like.
No. My super will not need to last that far.
I mean, I just read the other day some guy who, whenever he goes to San Francisco, he only ever gets a Waymo taxi, which is the driverless taxis. And San Francisco's full of them. You don't have to... So you can drive around San Francisco in a taxi with no driver. Well, I mean, that's... incredible.
It is incredible, yeah. So I think, Tiffany, I think those two things are the colliding forces for me. Population decreasing, but productivity potentially increasing through technology, but in ways that are difficult to project how it works. So, but terrific question.
David says, just caught up with your Jim Chalmers interview. I thought it was impressive that he could still recall the 5 key themes of the intergeneration report so clearly, despite being released in 2023. Can you give us a glimpse behind the scenes? Did he have notes, or is he just that good? Overall, an impressive and illuminating interview because he's such a good communicator. So, yeah, there was no notes.
He had one bit of paper that had what the spending rates or the economic growth rates were when Labor came to power and what they are now. It had 6 numbers on it.
Oh, yeah.
And he pulled that out for 1 minute. The rest of it was totally off his head. And David's right. It was pretty impressive.
It was.
I actually came away thinking he talks a lot like a macro strategist.
Yeah.
And you don't often hear... I mean, maybe it was the forum where he was able to talk to that in that way, in a way that he's... Because we gave him time, it was time to talk like that.
I know. I mean, I came away thinking that the Labor Party's not letting enough of that show up. Most of what he's doing on TV and that is talking points. He's not actually being allowed to talk in the way that he
and that's by
did
design
with
too,
us, and it's by design. And the other thing is that we're getting too much of Anthony Albanese, who is not impressive at all, in my opinion.
Yeah.
Anyway.
Andrew says, I read your article on a healthcare revolution, which is a story, Alan, we'll get you to explain this, but it's about Adney Private Hospital in Kew. It seems like a grand experiment to have private health systems work closely together and reduce or eliminate patient costs. However, we often hear that we don't want insurers to be providers like in the US. We had a couple of questions. Dee asked a question about this as well. So tell us a bit about it, Alan.
So my wife had to have a procedure. We went to this hospital. It's a new hospital in Kew called Adney Private, and we were getting triaged. I was with her, and we were getting triaged, and I started interviewing the triage nurse, as you do. I'm saying, how does this place work? Who owns it?
Did she ask if it was on the record?
No. So I learned enough from her to realise this was interesting.
Right, okay.
She said, basically the triage nurse told us that there are no out-of-pocket costs in this hospital.
Is it owned by an insurer?
So it's owned 49% by Medibank.
Right.
51% by 42 doctors.
Okay.
And it came about because of a guy called Michael Grigg, who was a vascular surgeon who used to be president of the College of Surgeons, and he decided that really, if the healthcare system is becoming unsustainable because all of these out-of-pocket costs for people who've got health insurance. You got health insurance.
Yeah.
You go into hospital for something or other, and you get whacked with bills.
Of course, yeah.
And he rightly thinks, well, that's hopeless because people are going to stop taking out health insurance.
So how do they reduce those out-of-pocket?
So it's kind of what's happened is that they've done individual deals with each of the doctors where they have agreed a price that the doctor charges, and the gap between the Medicare rebate on that particular procedure, whatever it is. I mean, there are 7,000 item numbers in Medicare, right?
Yep.
It isn't just GP visits. Obviously, there's every single possible operation and procedure has an item number and an amount. the gap between that and what the doctor wants is paid by the health fund and the hospital. So there's a combination of the health fund and the hospital, which is 49% the health fund, but also the doctors are chipping in. And so they've done those deals. And the doctors have agreed on a slightly lower thing because they all agree that the thing is unsustainable.
But was there any differences in care? For example, I mean, one of the big push when I speak to insurers is we're spending too long in hospital. We don't need to be in there for 2 days.
So the way the whole thing works, because they are doing what they call right stay,
right,
which is that it's short, it's shorter, and they're basically supporting people at home. So people go home a day after getting a knee replacement, for example, and they get a nurse who comes to the house and looks after them, and that's part of the deal. But it's cheaper to do that than it is to have them staying in the hospital for 5 days. It's cheaper to have them at home, so that they make it up that way.
So to Andrew's point, could this model be expanded, or is it boutique?
Yeah, well, Medibank wants to expand it. And the whole thing is this is an experiment, and it needs to be profitable. And so I spoke to Professor Grigg, who said that usually new hospitals take 5 years to become profitable. Yep. They reckon this one will get profitable in 12 to 18 months.
Wow.
And once it's profitable, within, say, 2 years, then they'll be able to go to Ramsay Health and to Epworth and Cabrini and other private hospitals and say, look, it works. Here's the deal.
Here's the model.
And they want to make it so that all other private hospitals do the same. So I think it's a big deal.
Yeah, I think it's a big deal for investors in Ramsay Healthcare, which is a listed company.
Well, because they're all going to go out of business. Well, that eventually,
because that assumes those hospitals are built on longer stays, more complex surgery. This is a very different model.
No, but they need, but that's right. They're built, but that's a short-term benefit. Long-term, unsustainable. The whole thing's unsustainable long-term.
Yeah.
Erin says last week, Nido was briefly mentioned. What are your thoughts on investing in Nido and similar education stocks? From my knowledge, there are no primary or secondary schools that have stocks on the ASX. How can a business deliver to shareholders but also attract competent staff to educate our children? Well, it's very interesting because primary and secondary education providers are not allowed to be profitable in Australia.
Right, yep.
Basically, it's got to be...
It's hard to be listed if you're not profitable.
So that's right. Primary and secondary education has to be not-for-profit.
Right.
Whereas kindergarten and anything up to the age of 6 or whatever you go into prep is allowed to be profitable. So therefore, a profit margin has to be built into the price.
Yep.
Which means that education, childcare up to the age of 6 is really expensive. Look, it's a very interesting question in terms of what's the long-term situation going to be. I mean, I'm wondering whether we're going to be satisfied with education, because people are increasingly talking about those years, particularly kindergarten, being education. Yes, that is a part of the education
That's
system.
Part of government policy, absolutely.
It's government policy that's education. So it seems to me that it has to, at some point, become not-for-profit, like primary schools. I mean, how can they continue to have a for-profit kindergarten and then switching to not-for-profit as soon as you go to prep?
But Erin's options for investing in education are going to be even more limited. That's what you're saying.
Well, that is what I'm saying. And I'm wondering about the long-term sustainability of stocks like Nido. I mean, Nido's I interviewed the CEO. He seems pretty good. The company seems okay. I mean, quite well run.
Yep.
They're kind of focusing on their margins and all that stuff. But really, I can't see how it lasts.
Yeah, fair enough.
Thanks, everyone, for listening to today's episode of the Money Café. Unfortunately, we didn't get through all the questions, which is great because we've got so many, but we'll save some for next week. Hopefully we'll get through them then, but then there'll be another whole lot of questions because they'll be sent in to the Money Café at eurekareport.com.au, and I'll be back with Stephen Mayne next week to answer them and to chat about the election, which is happening on the weekend.
And thanks particularly to all the female questioners. It's great to see. I think they're always been out there, but Stephen has roused them to write in, which he has. Good.
Good on you, Stephen. Okay, till next week, I'm Alan Kohler, founder of Eureka Report, finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.